Guys, so welcome back. Here we are talking about responsibility accounting, and I'll break that down in a second. But in our previous slide, we talked a little bit about centralized and decentralized operations, and so for the time being, now we're going to just focus primarily on decentralized operations. Okay. All right. So under decentralized businesses, responsibility accounting basically assists managers in evaluating and controlling their area called responsibility centers. Now, before I get into all of the types of responsibility centers, I just want to give you some perspective. So when I was working at Fender as a consultant for them, there were three main product lines. So I'm going to draw it on here. There were three main product lines. There was the PL10 line, there was Jackson, and there was, I remember it being Custom Shop. It may be another name, but that's what I can remember right now. And so for each of these product lines, right? So if you like Strats, for instance, like most of your Strats that goes to Guitar Center and your notable guitar places all would be like mainly Strats, and that would be part of the PL10 line. And Jackson would be more so of for like customization and things like that, and then so would be Custom Shop, but this would be like a different range in price in regards to how custom they would be, right? And so under the Jackson product line, there would be, different types of guitars, things of that nature, right? But in each of these product lines, there would be a product line manager, right? They would be in charge of the entire operation just for this particular product line. So we had a manager, he would, if anything broke down or if there was any kind of issues in the whole production of PL10 guitars, he would attend to it. And so would be Jackson and Custom Shop. This one person was like the president of, or the manager of those different product lines, and they answered to like the higher bosses if there was any issues, right? And then probably the same thing could be said about maybe an Apple, right? Apple product. Maybe you have the iPad, and then you have the Mac, and then you have the AirPods, and then you have the iPhone, right? And so then there is all of these product managers for each of these different divisions, right? And that is to keep everyone accountable for what's going on in the organization and things of that nature, right? All right. So hopefully you got what I just put out there. So let's keep going with that. All right. So the three different types of responsibility centers in the ones that I mentioned is cost centers, profit centers, and investment centers. Each level has a different type of responsibility, and you'll see exactly what I mean in a second. Now, under cost center, as it states, they're only responsible for cost. So think of every single cost you can think of: HR expenses like payroll expenses, property taxes, rent expense, so forth and so on, right? They're only responsible for the cost of that location. Now, I've had the opportunity to work with a cost center, and that one was for Fender. When I worked at their particular facility, they had so many different departments, and at the facility in Corona, they were only responsible for reducing, or not only producing the guitar, but reducing the cost of the guitar. None of the sales of that product was done at that location, only the manufacturing process, okay? All right, now profit center is a little more responsibility. Under this particular responsibility center, the manager is in charge of revenue and cost. Now, again, I have some experience from this perspective. When I was working at my prior company to Fender called Cargill, we were the manufacturer, or we were a distribution center for protein. And so on the West Coast, we were in charge of connecting customers with the proteins that we were selling. We were like the middleman, right? So in that organization, we're responsible for not only generating revenue, but also decreasing costs. Profit center is basically saying this manager is in charge of the income statement, because the income statement houses all of your revenue and all of your costs, also known as expenses. Now, your very last responsibility center is the investment center, and it's the most involved out of all three. The investment center, they're responsible for revenue, cost, and investments into assets. Now, unfortunately, I haven't had that experience in investment centers before, but yeah, that's what I have to offer. Okay, so let's talk about cost centers for a second. Now, cost centers, as mentioned in the prior slide, the manager is only responsible for controlling costs or expenses, right? So there's no decisions concerning sales or investments. That's not their intersection, right? They're not responsible for that particular part. So cost centers can vary in size. It could be a small department, or it can be an entire manufacturing plant. And then usually use a budget performance report prepared for budgeted and actual costs for the cost centers. So here in this particular example, what we see is a budget performance report, and it rolls up into the other. Now, if you don't quite know what I mean by that, is first, this budget performance starts here. It starts with the supervisor department of plant A, right? So imagine this is, let's keep going with the Apple example. So imagine this is the iPhone, right? This, when we're talking about department 1 or what have you, this is the iPhone, right? And then, so this is the budgeted number. So if you remember back into chapter 7, we talked all about budgets and actuals, and even into chapter 8, I believe, we talked about a little bit of comparing budget versus actual. And so what you see is your budget versus actual, and then you see if it was over budget versus under budget, right? But then the iPhone then rolls up into this report. And so here's all your numbers. You see 109, 111, so forth. All of that then rolls up to here, because remember, this is department number 1 and plant A. This is plant A. Now, maybe this would be, say, I don't know. Maybe the iPhone was a bad idea. Let's say, no, it could be for the iPhone, but let's say this is for the Southwest region. Okay, all right, whatever. All right, so then what we're gonna do is now look at our actual versus budget for each of the departments in Plant A, because Plant A has department number 1, department number 2, and department number 3. What we've basically seen was a slice of the cake in department number 1. So anyways, you're doing a comparison between your budget and actual, and then you see if there's an over budget versus under budget. Then those numbers, all of this now rolls into this one, the bigger budget. And now this is what goes to the vice president or your CEO or your CFO. They're looking at the bigger picture, right? They're not looking at these smaller details. They're looking at the overview. And then in the case or in the event of, hey, I don't quite understand why Plant A, because this is what we're talking about for a second, they may say, I don't understand why Plant A is over budget by $2,855. Well, that's where all of this detail now comes into play, because then we can say, oh, well, it's coming from maybe department number 1 or 2 or 3 and so forth and so on. Okay, so all of these reports are just rolling up into the overview report. Now, when you're looking at maybe the overview or just your over budgets and under budgets, as we talked about in chapter number 8, I believe, we talked about how sometimes there can be issues that take place, right? So one of those issues of something being over budget or under budget is there could be a machine malfunction, right? So remember in chapter 8, we talked about how there could be direct labor variances or direct material variances or factory overhead variances. And so whenever it's time, excuse me, to maybe have a discussion on why they're over budget, or we see that the materials department or the materials are over budget. And then usually if you're going to be talking about this, and maybe if this is in the millions of dollars, they want to know why is it over budget. And then that goes back to chapter 8 where we talked about, hey, well, maybe the purchasing department is buying really cheap material and it's being consumed up. Or maybe the cost of the materials is not more expensive when we haven't accounted for that, right? And so you can also look at factory wages, right? At factory wages, we're under budget. So then we would try to understand why are we under budget when it comes to wages. And if you remember back to chapter 8, I said usually when we're talking about under budget, no one really pays a lot of attention to under budgets. But when you're over budget, you try to come up with an explanation, and we looked at those explanations. And so here are some machine malfunctions, improperly trained employees, and low quality material. Okay. So anyways, that was me trying to explain the cost center and then how it plays into what we've already learned in chapter 8, which is the budget performance report. All right, so here's a really good example for you guys to walk through. You have the budgetary performance for a cost center. So you have Vinton Company costs were under budget by $36,000. The company is divided into North and South regions. The North region cost was over budget by $45,000. So it's asking you to determine the amount that the South region costs were over or under budget. Okay. All right. Let's see. With this video, I'm gonna take a pause and let you guys work through this. And let me know what answer you come up with, or if you can, how did you come up with the answer? Okay. And then I'll pick this back up in the next